Giving back is part of our cultural fabric at Nikola Wealth, and that is why we support our clients' efforts to make philanthropy an integrated part of their financial plan. It is important to us that their family's wealth and values can be meaningfully passed on from one generation to the next, helping to build true legacy. One of the ways we do this is through our Nikola Wealth Private Giving Foundation, a philanthropic investment structure where we cover all the administrative costs, providing a cost-effective and tax-efficient version of a family foundation. This can be a powerful financial vehicle for giving, minimizing tax while maximizing a family's gift-giving potential. This structure allows you to give during your highest earning years and build an endowment that can give in perpetuity for years and generations to come. We've found that going through this process of planning as a family presents an ideal opportunity to engage children in the family's financial planning and introduce the concepts of investing, providing them exposure to some basic financial education and allowing the next generation to influence the impact of the family's donations. We believe in doing well by doing good. Integrating giving into one's financial plan means finding the best ways to give back for a brighter future for your family and our communities.
Hello, my name is Rick Gosen. I do business development across Canada at Nikola Wealth. Welcome to today's webinar. The topic of our webinar is Do Well by Doing Good. And the subtitle is Smarter, Tax-Effective Strategic Giving. Welcome to this webinar. I'd like to, at the outset, highlight a few procedural items. First of all, this webinar will go approximately 1 hour. Thank you very much for allocating your time. Secondly, our presentation is intended to generate a lot of questions, and we hope to provide a lot of answers related to strategic, tax-effective giving. So you'll see at the bottom of your screen, there's a Q&A icon. We'd encourage you to ask questions throughout the presentation. We will have a time at the end to address your questions, but if something occurs to you as the presentation is ongoing, definitely submit the question and I'll make sure they're forwarded on to our presenter, my colleague, Ron Hake. I'd like to just point out at the outset that we appreciate you taking the time to join us on this very important topic. And one thing I'd like to focus on at the outset is sometimes we concentrate on the how and the mechanics, which are important, but we don't always think about the why. So I think before we get started, I'd like to encourage you to just think briefly about the why of giving. Which are the causes that resonate with you, that have made an impact on you during your life's journey? What are those causes? And wouldn't it be a great thing if you can magnify your impact by giving strategically? So again, today we'll go through the how, but I think it's always good to remember the why that's underlying and that's part of your motivation for even thinking about giving. So that leads me to a key question. What is more important? Is it how much money you give or how you give it? And that's an interesting question because most people focus on how much money's given. They'll think about how much they can allocate to philanthropic objectives. But the reality is, it's not just how much people give, but it's very important how they give. What we want to focus on during our presentation today is the importance of being a strategic giver. We might call that being a wise steward. And the wise steward of their resources realizes that it's not just one or the other, how much you give or how you give it, but it's actually both. So let me give you a practical example. Can you make a $100,000 donation for a cost of less than $10,000? That might seem a bit staggering, but in fact, that is possible. And that's one thing my colleague Ron will be covering off later in the presentation. So this presentation is intended to introduce you to smarter, tax-effective giving strategies so that you will be able to do well by doing good. Now, before I introduce Ron, let me just say a little bit about Nikola Wealth. Nikola Wealth manages approximately $11 billion. Our client retention rate is 99%. 4 to 5 new clients come via referrals. We focus on advising entrepreneurs, professionals, high net worth business owners, and their families. And you can see that the firm has been recognized in the industry for its excellence in management and leadership. So that's a bit about Nikola, and of course, there's a lot more information on our website. I now would like to introduce my colleague, Ron. Ron Hake has extensive, Ron has extensive credentials in the field and also has been in the financial services industry for over 20 years and spent a lot of time advising individuals in the high net worth segment. Ron, I'd like to pass it over to you to continue with the presentation. Welcome.
Thank you, Rick. Good to see you. And everybody, thank you for joining us today. And as Rick said, this is designed to be interactive. We hope the information we're going to share with you today is of help to you in terms of your planning and maybe shed some new concepts and light the way for you. So please feel free to put questions in the Q&A section. And from time to time, Rick will jump in with some questions that might be pertinent. I find that before we maybe start looking at the opportunities, let's maybe spend a little bit of time looking at how does Canada stack up against the world when it comes to giving. Now, this is from the Charities Aid Foundation 2019 October report, what you're seeing here. And it's a 10-year aggregate score or ranking. The red is the aggregate. The blue is whether we've helped a stranger. The purple is if we've given money, and the darker purple or black is giving time. And so when we start to look at how Canada ranks, when it comes to giving money, we're certainly in the top 10, leading the way in terms of on a per capita basis is Myanmar and UK second. So we're certainly up there in terms of the way we give financially and in terms of collaboratively, both in terms of giving time and so forth. So when we start to think about what's unique about our approach, I think when we start to think about Canadians and people in general, how do we give? There's 3 types of gifting. The first is I would call at the door, and we'll go into each one of these in a moment. Second might be planned giving, and I think many of us are familiar certainly with the first 2. And the third we think is a unique approach. It's called strategic philanthropy, and we're going to shed some light on that. So when we talk about at the door, this is really friends and family. Think about, you're participating in a walkathon or a ride for conquering cancer, or you're giving at your church or your temple. And this is what I would call very transactionary in nature. It's typically as a result of a response to an ask. Someone says, hey, I'm collecting money for X, Y, and Z. And so Canadians are pretty generous. And certainly that's a big part of what we do at the door. The second part in terms of giving we talked about is planned giving. So what is planned giving? It refers basically to planning your estate to provide at death typically. This approach is quite common. It mitigates some of the taxes that one might incur upon death, though you don't really get the benefit of seeing your giving affect the change. So what you see up here in front of you are some of the tax rates associated with Ontario and what happens upon death. Now, why are we looking at these tax rates? Because they certainly have an impact. And as we go through some examples, we're going to show you how they have an impact on what's left behind for the charities or beneficiaries of your choice. So before we look at the tax rates in greater detail or an example, let's first look at what's tax-free. So in Canada right now, tax-free are these 4 items: your principal residence, tax-free savings accounts, lottery winnings, and any life insurance proceeds. Now, principal residence for now, there was talk in the recent run-up to the election that that would be something that someone might look at some point. I would say, from my perspective, I think this is an untouchable asset. I think it would be, political suicide for someone to start taxing the principal residence. For those of you who are not familiar, TFSAs are tax-free savings accounts. That's available to most of us here in Canada, and the current maximum is about $75,500. When we start to look at taxes and the tax grind, let's look at what a registered account might do. and a non-registered account here. So a non-registered account of $1 million, conservatively earning 4% for 25 years. If it was a zero tax environment, you'd have about 2.6 million after that period of time. In Ontario, that tax grinds you down to about 1.5. And so you're getting a cumulative loss of about $1 million here. Now, why are we so focused on taxes when it comes to charitable giving? And that's because in Canada, there's 3 possible beneficiaries to your estate. And if I said to all of you here on this call, please choose 2 of them, I suspect nobody's going to choose the government. So while it is important to focus on taxes, it's also important to look at what the end result or desired result is, and then reverse engineer and work backwards. So taxes do have an effect of shaping our behaviors, and that's why we focus on that.
Hey, Ron, if I can just interject here.
Yep.
Now, I notice you talk about assets being distributed to beneficiaries, but why wouldn't someone just focus on the cash they have? Isn't that the simplest, most effective thing to do?
A good question. So while it's the simplest approach in terms of giving, it doesn't necessarily maximize your giving. You're not with the same original dollars. There are better ways of taking the capital you have available to you and maximizing your effective giving. And I think one way maybe to highlight that is there was an old Morgan Stanley advertisement many years ago, and it really resonates with me, is you must pay taxes, but there's no law that says you got to leave a tip. And so our goal today is to provide you with some tips, ironically speaking, so that you're not leaving money on the table for CRA, but rather for your chosen beneficiaries. So let's look at a specific example. So what we have here is a tale of 2 clients. We have Mr. Brown and Ms. Smith. They are identical in every way. So both are 50 years young. They have some earning potential, RSPs, corporate investments. So they have, maybe a holding company or an operating company. They are saving the exact same. So their goals and objectives right now, or sorry, their goals, their savings capacity is identical. But when we start to dig a little deeper and we look at how the outcome might happen, we can see that Mr. Brown had no desire for life insurance. He believed that, well, my spouse will have more than enough. And he's right, at age 70, there's going to be nearly 9 million in corporate assets and 2.5 million in an RSP. Ms. Smith, though, working with her advisor, recognized that you could actually reallocate some of the investments into a tax-free asset class. Remember, a few moments ago, we looked at that. One of those is insurance. And why would they do that? To facilitate a better outcome with perhaps, in fact, less risk. So the only difference here is the usage of life insurance. So at the age of 70, by investing $150,000 into the corporation in a participating whole life policy, so instead of taking the full 250 into the corp in terms of investments, 150 into the corp, 100,000 into the participating whole life within the corp. And then we look at at age 70, there is a difference. At age 70, Mr. Brown has about $2.7 million more in his corporate. But Ms. Smith has a life insurance cash value of nearly 5 million with a death benefit of 8 million. So let's see how that plays out. And it plays out because there are 3 levels of taxation that one needs to be mindful of. The first level of taxation is your personal cap gain on the disposition of your shares of the corporation. So in our example here, both individuals set up their corporation with a value of $1, and the value of those shares, which are linked to the corporate investments, have grown. And in Mr. Brown's case, it was 8.7 million. In Ms. Smith's case, it's 6 million. So there is the disposition of the shares of the corporation, not the underlying shares or the investments, but the shares of the corporation. The second level of tax is the corporate tax on the sale of the corporate investments. So we've got to now liquidate those corporate investments that are underneath there in order to give the beneficiaries their portion. And so these investments have to be sold. And this could result in a taxable capital gain. While it does generate something called a refundable dividend tax on hand and a capital dividend, both are helpful in reducing tax, there is still an underlying strip, if you will, of the benefit. And the third onerous piece here on this is the dividend tax on distribution of assets of the personal tax rate. So we've sold the investments within the corporation. Now we've got to get those assets out to the beneficiaries, whether it's a charity, whether it's kids or whomever. So when these investments are sold, the cash is actually distributed to the heirs in the form of a dividend. And the heirs receive that dividend from the corporation, thus further grinding. So Ron, what does that look like in terms of actual dollars and cents? Let's look at this situation here. And what we can see is that at the end of the day, Ms. Smith has nearly a 5 times left for her beneficiaries at the end. Because Mr. Brown was solely focused on asset accumulation, he wanted a bigger nut at the beginning. Because he had no life insurance, about 71% of the assets were lost to tax. But because of the preferred tax treatment of life insurance, and Ms. Smith's estate only paid about 29%. So you can see that the end result is quite impactful to the children and maybe the charities. So when you start to look at your giving strategies, there are a number of ways in which one can gift.
Ron, if I can just interject right there, I've got a question regarding when you show that example, it looks like it should be obvious that the normal person would rather have an impact 5 times greater. So if that seems so clear, what would be the barrier to someone pursuing this course of action? You know, bearing in mind that we have a lot of people listening who may see that and go, well, that's pretty obvious, but if it's obvious, why wouldn't somebody do that?
Great question. So thank you for that. I think it's maybe obvious as we look at it this way. When you look at the numbers, you say, what would you like? I think where it's not so obvious is your advisor working with you to identify that and reverse engineer the process. So understanding what your objectives are, understanding what your end goals are, and then trying to come out with the best result. Now, remember, we have multiple competing priorities here. If your number one priority is to ensure that the most is left behind for your charities and your children, this might be one way. But there may be other priorities along the way. Maybe you're looking to buy a second property. Maybe you've got to provide for kids. So it's important to work with your advisor so that your advisor can understand what your priorities are today. And I say the word today because it does change. You've got to revisit these things on a regular basis. The plans that we put into place today are not necessarily plans that are going to hold up in 6 months or a year's time, depending on your objectives tax rates. So thank you for that. Good question. And so maybe that's a great segue into, what are the options when you start to look at, you have a giving desire. What are the gifting options? Typically, through a will, your bequest in your will. Many people will look at RSPs or RRIFs, and we're going to look at each one of these: marketable securities and life insurance. So the simplest one, and the one that most people do, and these are all examples of planned giving, as I talked about earlier, which is really, you change your will. You leave a fixed amount or percentage to the estate of your estate to your favorite beneficiaries. Part of what you should be doing is notifying those beneficiaries that it exists so that they're aware of it. Also notify the financial institutions, if you're going to designate some of your RSP or RRIF. And when we speak of the RRIF and RSP, it is a tax time bomb, if you will. At the death of a final spouse, the entire RSP or RRIF is taxed as income, nearly 54% in Ontario. So a $2 million RRIF combined, and that's not uncommon if you have a couple of RRIFs that have come together, might only net out less than $920,000 to your heirs. Typically, wealthy people are only taking the RRIF minimums. And so it is a bit discriminatory in the sense that the government is discriminating against people who are single or divorced or widow in terms of the tax time bomb, if you will. When we start to look at gifting your RRIF, so let's look at an example where the RRIF is $2 million at age 71. The mandatory year one withdrawal might be $106,000. So your net income might be about $48,000. So how could you gift your RRIF, not at the end, but while you're alive still? One way certainly is to just take the net income, write a check, and that's $48,000. Bigger impact might be to purchase a life insurance policy for 1.2 million with that net income, that 48,000. And what you might want to consider is, hey, I'm going to give 600,000 upon my death to charity, 600,000 to heirs. And so what that outcome is a $600,000 tax receipt for the estate upon death. And ultimately, that means that the heirs will net out close to $900,000 and the net after-tax balance of the RRIF. So it's not about necessarily one or the other. You can employ part of this while you're alive and taking out your RRIF income. And certainly you can look at employing part of donating all your RRIF upon death as well. So again, goes back to planning and understanding what you're trying to achieve. The next area maybe we'll focus on is the gift of marketable securities. And this is a popular one. Let's look at an individual who currently gifts $50,000 cash annually. And now the client gifts 50,000 shares instead with a cost base of 10,000. So what ends up happening is there's no capital gains tax. So they've saved that tax. They get the full receipt for $50,000. And so that's certainly an opportunity to, instead of giving cash, that was a question he asked before. So instead of selling the stock, taking the cash proceeds, this is a better outcome from the client's perspective and from the charity's perspective as well.
Ron, sorry to interject, but I just have another question here. Of course, in Canada, we function within this tax environment, which is subject to change somewhat quickly at times. So do you have any sense as to, are there any potential tax changes coming along due to the political motivations of the governing parties, or is there something in the wind that might impact either positively or negatively the various strategies you're talking about?
Yeah. So with the recent election promises, there certainly was talk of tax rates going up, whether it was a wealth tax. But I think the one that most people are focusing on today and think is likely a foregone conclusion is the capital gains tax rate going up, the inclusion rate. So currently it's at 50%. In the past, it's been as high as 75%. And there is, I think, consensus that it's going up, whether it's to 66, which it has been in the past, or 75. So for donation planning, there's no effect on this. But when you start to think about sales of other appreciated assets, absolutely. You think about if you're planning on selling a business or an investment property or a stock position and has had significant gains, there may be money left on the table depending on when you're electing to take that gain. Many people are looking at that, and that's why they're doing something called the capital gains strip as well. So all of this is really, I should be saying, you got to be working with your advisor, guiding you on looking at this in conjunction really with some of your overall objectives and your financial planning. You got to keep going back to that, and you're going to hear me say that quite often today.
Right. And Ron, there's another question here. Maybe it's a point of clarification. One individual asks, I thought the elimination of the capital gains tax when you donate securities was eliminated a few years back.
Yes, and I think that's what we're saying here. So there is no capital gains tax when you are donating. So what we're trying to show and illustrate here is the difference between someone who gives cash versus someone who, so I sold something, paid the tax, and then gave cash, versus someone who donated an appreciated security. So the individual asking the question is correct, and I think we're trying to demonstrate that here, is that you are better off donating appreciated securities. So
maybe just there's one more issue that often comes up.
Yeah.
From a big picture strategic planning standpoint, where do you find people put their emphasis? Is it on giving through their estate, i.e., when in a sense you could say they don't need it anymore, versus giving while they're living? So do you have any advice from a planning standpoint where people maybe should put more emphasis?
The answer is yes, and I think I'm going to get to that in a couple slides. And I think I'll just summarize by just or give you a preview of that by saying that strategic planning, and this is what we're going to get to, is every day. It's thinking about it every day in conjunction with everything. So it's not end of life planning. It's not motivated simply by taxes. It's when does it make sense? It's strategic in nature. And maybe this point here around life insurance might be a way to illustrate that. So there are a number of ways of gifting life insurance. One is to gift an existing policy. You can do that including a term policy. And what would happen is you'd get a receipt for the full fair market value. So if you think about even a term policy, let's say I got it when I was 40 years young and now I'm 70, and maybe it's a term 100 or whatever kind of policy, although there may not be a cash value, there's an actuarial value on that. And so it is important to get it for the full market value. You're going to get a charitable receipt. If you're still making premium payments, you'll get a charitable receipt for those future premiums. And then as well, you can gift a new policy, just like I showed on a previous example. And if that's the case, you would take out a new policy. In the case of my RRIF example, your annual premiums might be eligible for charitable tax receipt. You can also gift the insurance death benefit. And then that means a tax receipt is issued for the entire death benefit and can offset your estate taxes. And then under numbers 2 and 3, the important thing is the donor still has control over policy. So often we make these decisions, things are good, but then life changes, things happen. And so, you need to maybe make some changes. So under options 2 and 3, you can still change the beneficiary at a later time. And I think that's important for people to be aware of as they're starting to look at different options. You can donate the death benefit through the will. We talked about that, or designate the charity under a policy. But if it is through your will, be careful about 2 things. One is probate fees and someone making a dependent relief claim. Another new novel way of doing this, again, if you're working with a financial planner, they're going to look at—
Sorry, Ron, there's just another question. Sorry to interject there, but before you hit that next topic, there's a question which I'm glad has come up because it's very, let's say, topical, related to cryptocurrencies, which we keep hearing about and need to familiarize ourselves with. So the question is the gift of cryptocurrencies treated the same as the gift of marketable securities? How are charities set up to receive marketable securities or cryptocurrencies?
So most charities are set up to receive marketable securities. And again, it's always important before you're enacting anything, any strategy, to check with the intended recipient. First of all, are they registered in Canada? So that's an important one. Many of us like to support, worldwide causes. You might be supporting something that has a foreign component. You want to make sure that that foreign charity has a CRA registration as well. Many of them will have that. Secondly, are they set up to accept those marketable securities? Many will be. Again, it depends on the charity. In terms of being able to accept cryptocurrency, I would say that that's very much like some of the other items we're going to look at soon, which is private company shares and real estate and so forth. In theory, yes, but it all depends on how that's transacted. So again, in a theoretical example, that charity should have a crypto account and be able to receive it. And there should be documentation relating to, what was the adjusted cost base, i.e. what did I acquire it at, and versus what am I giving it at? And when you're talking about cryptocurrency and how volatile it can be, it's important to be aware that it's at the time that you donate that currency or that cryptocurrency that there may be that tax rate is going to be fixed. So,
right. Yeah, that's great. And if I can just point out to everyone, thanks a lot for the questions thus far. Believe it or not, we're already at the halfway point. So I would just encourage everyone that if you have questions, then definitely keep posing them and I'll forward them on to Ron. And we'll be ending again in exactly 30 minutes, so 1 hour in total. So when you have those questions, just fire them in. Back to you, Ron.
Thank you, Rick. So when you're working with your advisor and you start to think about retirement and you've got different sources of income, if you've been successful and you've been blessed, maybe you've got more than enough money and you don't need your Canada pension plan. Certainly you've put into it, you're entitled to it. And the maximum now is about $1,200 a month, about almost $14,500 per person per year. So when you think about 2 individuals or a 2-household individual, that CPP benefit you're receiving, it's taxed in your hands, you're investing it, possibly because you don't need it, and then you're being retaxed on it. One area that you might want to look at is say, well, maybe if I don't need that income, I can use that cash flow to create a charitable gift of life insurance. So again, it's not always about having a big impact today. It can have a large impact and a very meaningful impact to the charity, when the last of you is gone. So today, a 65-year-old couple might be able to get a $1.4 million policy. And it just means that there's a meaningful windfall for your family and or charity. So when we talk about philanthropy, and specifically strategic philanthropy, our definition, the way we would look at this, is you need to incorporate this philanthropic discussion at every meeting with your advisor. And if you are not bringing it to your advisor's attention, your advisor certainly should be bringing it to your attention. Hey, have you thought about this? Is this something that you're interested in? And for many of our clients and for many individuals, it's really looks like this. You've got a bucket of current assets. Your investment assets continue to grow. Maybe there's a sale of a business or some real estate that's going to happen. And so that's perhaps the impetus somewhere along there, at least, to have that discussion, because you're going to have this capital that is going to be more than enough to sustain you for your lifestyle. Then you're going to have excess capital. And if you look at the far right-hand side there, you can see, again, the three beneficiaries are going to be your estate, either maybe through insurance or your taxes. And so, one of the roles that we would see ourselves working with our clients on is really putting it together in such a way that it's interconnected. It's what we call integrated planning. So you can see that, it deals with your business structure and succession planning. Let's look at tax reduction strategies. Let's look at wills and estate and legacy planning, whether it means reviewing your insurance needs, whether it's charitable giving, what's your retirement income modeling. So all of these things are moving in tandem, and they're interconnected in such a way that a great advisor is got their eye on a number of moving parts.
Hey, Ron, there's another
Yes.
question that came in. I thought this would be a good time to forward it to you. So this relates to gold. How are gold coins? Now, I would assume whether it's a gold coin or a gold bar, but the question is, how are gold coins, which have been accumulated, say, over 40 years, taxed? So let's just say it's gold, you've had it for a while, it may be difficult to determine what the original purchase price was.
So CRA requires the investor or the individual holding that asset to have proof of what their acquisition cost was. So at some point I bought that gold coin. Maybe I bought it at $1,000 an ounce, or maybe I was lucky enough back in mid 90s to pick it up at $250 an ounce, and I bought a bunch, and it's been sitting in my safety deposit box since then for 30 years. It's incumbent upon me to have proof of what my acquisition cost was. My disposition cost is on the day that we donate that, right? Or if we're selling it or whatever the case is. So it is incumbent upon us. Otherwise, CRA might make their own determination. Often, if you don't have, an actual receipt, but you have an idea, CRA may or may not accept the average price during that period of time. But it also brings up a good point, which is in Canada, it's Canadian dollars. So keep in mind that, if you bought that gold at a time where US dollar was trading at 65 cents and today it's trading at a much higher level, there may be an impact on there. So it's not just the price of the acquisition, it's the price in your Canadian dollars, because that's what they're looking at. Great. So when we talk about integrated planning, and we talk about specifically today, when we talk about what we do at Nikola in terms of planning for our clients and some of the foundation work that we do, you saw that in the beginning there was a short video about our Donoradvised Foundation. So I think I want to spend a little bit of time, because it does tie into perhaps the a couple of items we want to highlight for you. So it is a donor-advised foundation. In other words, a Canadian registered charity. It accepts donations, it issues tax receipts, and then subsequently can make grants to other Canadian registered charities. And why that's important is because it can strategically maximize the benefit of a large contribution in a given year. If you think about to sell a business, you might have a one opportunity, or big real estate, you may have an opportunity to mitigate some of that tax, put it into a donor advised foundation, but you don't want to necessarily give it all away that year. So it allows you to put it all into this donor advised fund, and over time, your own personal donor advised fund provides some grants throughout many years. It allows you to grow your legacy by making a donation maybe during lean years and in fact giving in perpetuity, which many of our clients do. When we think about our approach, you can make donations in cash. We don't think that's the best way of doing it, but you can also do it in kind: mutual funds, stocks, bonds, real estate, insurance policies, and even under certain circumstances, you can actually donate some private company shares. Of course, this has to be discussed with your advisor. The one thing that we believe here at Nikola is that there should be no administrative costs to the clients. We actually bear the cost of administrative services to the PGF or private giving foundation. Many cities have great community foundations. Typically, there is an administrative cost of around 1 to 1.5% to run those. And while at Nikola, there is that administrative cost, we actually bear that cost so that more of the client giving can actually see it through to the recipient charity. I think when we're talking about today, and I think you alluded to this earlier, Rick, which is, how can you make a $100,000 donation that costs less than $10,000? How is that even possible? I'm going to go through with an example of a scenario in Ontario and how this can be done. Again, quite important to always involve an advisor. There's some complexity here. But it is the use of what we call flow-through shares, okay? So please reach out to your advisor for further information. But essentially, what are flow-throughs? They're based upon certain tax credits that called Canadian Exploration Expense, or CEE, that the federal and provincial government provides to companies that are then packaged and sold to investors. This is under the Income Tax Act. I think it's section 66, sub 15. And there's a subscription agreement. And what ends up happening is the donor who subscribes to these shares immediately turns around and donates to the desired charity. In this case, it can be a private giving foundation. The charity then immediately shares the sells the donated shares to a prearranged third party. And so it removes some of that risk in terms of the share valuation. And proceeding this way, the donor gets to deduct the CEE credits in respect of the flow-through shares. They claim the investment tax credits and the charitable tax credits. And what this does is it combines to eliminate the income tax on the capital gains from the gifts of a public share. So let's actually walk through an example here. In this case here, the cash paid upon subscription was $422. There was an immediate sale, so cash comes back in the form of about $163,000. So the net cash immediately post-closing out of pocket is $258,000. There is going to be a tax savings of about $280,000, which means that an after-tax position of about $22,000. In terms of after tax, the tax payable is about $32,000, which means that the net out of pocket after cost donation to you is about $10,000, but the charity receives about $100,000.
Hey, Ron, a quick question came in just on this exact example. Is there not a waiting period for this share gift of flow through?
You can, it depends. So this is a good question because not all flow through shares are the same. And this is why you need to engage an expert in this. There are a couple providers in Canada who do this, and we work with a couple of them. What we would look at is ensuring that there's a structured sale. And so that's where I mentioned it earlier, which is this is a prearranged, immediate third-party turnaround purchase, usually at a discount, and that's what creates this certainty, if you will.
And one thing maybe to highlight is this is all within the regulations, so you're not pushing the envelope here. This is just, it's within the regulations. It can be done. It's a bit more complicated than simply cutting a check, but this is something obviously you've done before, it works, and it's for, which type of clients would you say this is best suited for, this type of opportunity?
So we think it's best suited to those who are trying to make, a maximum impact. I think you have to understand how this works. We work directly with your accountant. So I think, and maybe that takes me to this piece here, right? Don't do any of this planning alone. So not just the flow through shares. There's complexity. You may have a corporation, you may have RSPs, you may have assets abroad. There's going to be complexity. Every situation is very different. It's not just that there's complexity, there's fluidity. A lot of this changes from time to time, whether it's your personal circumstances, there could be changing tax rates. So, the advice you're getting today may not be relevant in a year's time or 10 years time. So that's why we're always looking at these things. And it is important to engage individuals with a level of expertise in this area, specifically someone who has that expertise in terms of bench strength, in terms of not just the financial planning, but also the estate planning and the private giving. I think it's all combined in one way.
Ronna, there's a few more questions related to this flow through example, which I would expect, given that it seems almost hard to believe on one level. But so one of the questions is, isn't the Liberal government planning to eliminate flow through shares in the oil and gas industry? Are you aware of that?
I haven't seen that, but it's been a mainstay for several decades, this scenario, and flow through shares are certainly do draw upon the exploration of mining and minerals, and oil and gas exploration. But again, that's where I talked about it being fluid and things are going to change. So if it is, you got to pivot. You still have other opportunities available to you, we think, and it's not a all or none scenario.
Mm-hmm. Yeah. No, that's great. Well, we're now getting close to the end of this presentation. We have a few more questions that are coming in. Okay. But just to wrap up on the thrust of the presentation, so what we've tried to emphasize, it's not just how much you give, but of course how you give it. And we've tried to focus on some of these smarter, tax-effective, strategic giving techniques or opportunities. And I think it just reflects the fact that people may have decided to give a certain amount, but there's opportunities to magnify the impact of your giving. And as we alluded to at the start of the presentation, we've been talking about the how, the mechanics, but of course, behind that is the why. What are the important causes to you? How could you give even more generously to those causes? So the bottom line is, on the next slide, Ron, if you can. So the idea is that you can be a strategic giver, a wise steward, and in fact, we believe you can do well by doing good. We're at about 1:45, so we have 15 minutes. We have a number of questions that have been coming in, so I'd encourage you to keep forwarding the questions to me, but I've got a couple that have accumulated. So one question, what's the single biggest mistake you see people make, when it comes to this, and there's these opportunities, but what's a mistake or two that people commonly make, which you could advise people to navigate around?
So I would say that's a two-part thing. It's doing it yourself, not reaching out and engaging individuals with expertise here. But I think even before that, it starts with the lack of planning. We often see, it's, as I said earlier, it's just a reactionary. Giving tends to be a reactionary. Someone says, will you support me? Will you donate? And those are good. Those are important. I don't want any of this to, come across as you shouldn't be doing that. But it is about planning, because gifting and strategic philanthropy specifically is part and parcel of your overall financial plan and estate plan. Business planning, succession planning. These are all, like we showed you earlier, that integrated wheel, they're all interconnected. And it's important that you spend the time and engage experts in this area.
Yeah, that ties in with another question here. How would, if there's somebody listening to this presentation and thinking, I make a certain amount of money, I've got a certain number of assets, but what's reasonable for me to give? I view myself as a generous person. I want to give effectively. How How would you respond to that? I mean, how do people know what they can afford to give responsibly, given that they have, as you alluded to, other goals, objectives of family and different assets?
So it's different for different people, but primarily I would say to you, you start with, taking care of your own house first, understanding what your needs are day to day. What are my, what have I been blessed with? So here's the pot I've been blessed with, it's X, but I only need Y for my day to day and for my long-term objectives. So once you can reverse engineer that process, you can then identify what assets are at play in terms of you've achieved financial independence. You're never going to need to draw on those other assets. If we go back to that chart that I showed earlier, it's that excess capital that I will never spend in my lifetime. How can I do more with it? And then again, working that into your financial plan. So understanding what your day-to-day needs are, what your long-term needs are, then understanding what you can give. And often you might think I can only give, use an example, $10,000 a year. Well, you can give it as a $10,000 a year donation, or you can go out and buy a life insurance on a $10,000 premium. And while you're getting that same tax credit, if you will, on that premium, your impact to the charity is going to be significantly better. Also, I would encourage you to think about, do I want to see, is it important for me to see my my effect while I'm alive? And that's a very reasonable request. Some clients, will say to us, look, I want to see and see those charities benefit today, rather than I'm gone and I won't see that benefit.
Yeah, that's
one
a great,
way of,
I'm sorry.
yeah, and one way of maybe getting both of that is that private family foundation. So many of our clients, they're creating a legacy and they're instilling their values, working with their kids, and it can be a multi-generational and multi-year approach. It doesn't need to be a one and done scenario.
Yeah, that's a great point. It ties back into the why of giving, that it's not just giving through your estate when you're not there to, let's say, participate in it, but rather look at, can you, in a sense, partner with various people and nonprofits and help them and enjoy and appreciate what they're doing. So we've got a number of questions that have come in. So so again, as I mentioned, people keep asking these questions. I'll get to as many as I can. So a question here, can the flow through strategy be used to donate into the private giving foundation? Are there limitations on the amounts? And does the 10-time benefit vary with situations?
So you can use flow-through shares, good question, to donate to a charity and to the private giving foundation. Remember that the private giving foundation is a charity, and so it can receive those things. Is there a limit? Typically, that limit is 75% of your income in any given year. So if I've, if I've retired and I'm only making $20,000 a year, we'll call it RRIF income, I can't go out and donate, $300,000 and expect to receive a credit or offsetting credit. Oh, it's only up to 75% of that income. It shouldn't stop you if you're so inclined and you're not tax driven to make those donations, but you cannot claim it in that current year. And so certainly, again, that's where you're looking at that scenario. In reference to the 10 times, that was an example used in Ontario earlier this year. These numbers change depending on the kind of flow through share available or in that period of time. So this was an earlier example in the first quarter of this year. Those flow through shares and subscription characteristics will change from time to time. But not, they're not going to go from 10 times to 1 time, but you do need to, again, before you get into any agreement, you need to map all this out with your advisor.
And of course, they're all specific to a particular organizing company, specific opportunity. So it would vary a bit, as you say. So there's another question here. I think this is almost like a classic question. Is it possible to gift an investment property intact? So i.e., as an ongoing entity which continues to maintain an income?
The answer is yes. The question becomes, so you've donated it. Now what are we doing? Are we asking the charity to run this on a go-forward basis? So you've got to be mindful of, what your outcome is. So let's say I bought that property for $1 million. It's now worth 10 million. It's great income. Why would anybody not want to hold on to it? Most charities got to look at the investments they hold and make the best outcome and the best decision for the charity as a whole. If they don't have that expertise, if they cannot engage someone to manage that property, or if they feel that the risk on that single asset just might be too great, they may in fact just say, thank you very much, transition, and just sell it out. And that's why it's important to engage your advisor and your charities in terms of that discussion and let them know what your expectations are. Maybe it's a property that's been in your family for 10, 20, 30, 40 years, and you want to see this in your family foundation or family fund.
Right.
Some may not be able to do that.
Well, and there's a few more questions here, but I just want to point out one thing, and that maybe you can comment on this, that on one level, if charities receive a check, that's pretty straightforward and simple. But from a charity standpoint, all these creative means, like what would your advice be for, say, individuals who are running nonprofits or charities? And I know there's a number on our webinar today. From their standpoint, how should they maybe approach this? In other words, there may be a lot of people out there who would want to be more generous, but it's not in the, let's call it the conventional way. So how can charities basically expand their pool of donors by the approach they take?
And so, good question. We actually will work with charities directly. So depending on the size of the charity, some may have their own giving people, if you will, their own individuals who work on plans and work on different ways and with donors. If you're a high profile charity, you may have a dedicated team specifically going out to source donors and work with their advisors, or maybe you have an in-house planning team. Smaller charities may reach out to us and say, hey, can you give our donors a presentation? Or we have a high profile donor. We don't have the in-house expertise. Could you come in and speak to our donor and do a plan and work with them? We're happy to do so. I think, a big part of our firm is giving back. At Nikola, we not only have this private giving foundation set up for our clients, we actually have our own private giving fund. As a firm, we donate a percentage of our profits every year, and we continue to do that. We think giving back, we're so fortunate and blessed to be in that position. So for those firms who are, those charities who are looking to partner up, certainly just reach out to Rick or I.
Well, and I think our firm, the sweet spot would be dealing with these, often more complex situations to achieve means to amplify, charitable impact. So there's another question here. So again, we've got about 8 minutes left. So definitely submit some more questions. So one question here, putting money in a foundation, what would be an average return for that foundation? And then how much do you have to give away each year?
So good question. There are rules and regulations regarding how much money has to be given away. So when you think about, I can speak to the private giving foundation we have, or PGF. If you were to set up your own foundation, you'd have to give about 3.5% away a year. Okay, so if we put 100,000 in and you've got all those administrative costs, you got to give away 3.5%. But in a scenario where you are part of a bigger foundation, like our private giving foundation or a community foundation, what we often see with our clients is that they're very generous and they're more than giving away. They're giving more than the 3.5% away. And so what ends up happening theoretically is you might have a situation where we have, 100, use an example, 100 individuals who donated the exact amount of money, but one individual decided into the private giving foundation, but one individual decided to give away 10% that year or 15. So long as the overarching foundation is giving away 3.5%, your private donor advice fund may not have to give away in that year that 3.5%. So that's the other piece, is that collectively we are stronger and we can do much better. But again, in terms of what an average return, I would encourage anybody who's interested in the returns of Nikola Wealth. We are very transparent. It's on our public website. You can absolutely go to that. You can see our investment performance, net of all fees up there for our core composite client. And, that information is publicly available to you.
And I think it's important to point out that we do work with many foundations, manage their assets. So it's something we're quite familiar with, and we're well aware of what best practices are and conventional norms in the industry. There's another question here. It's a bit of a comment, but I'll rephrase it a bit. One individual pointed out, well, the insurance strategy only works if you keep making the payments. So maybe you can just talk about how strategies vary. Some you make a payment, you're done, you give away something. Others, they will require ongoing commitments. So maybe just talk about how that fits into overall planning.
Great question. So you're right. Depends on the policy. So some policies, if you don't make the payment, there's no benefit anymore. Let's take a simple example, term policy, term 10, term 20, term 100, whatever it is. Every year or every month, or whatever it is, you've got to make those payments. So you can turn to the charity and you can say, hey, I'm willing to give this to you. You guys can start making the payments. So at that point, you do not receive any benefit in terms of the premiums, but you would get for the death benefit on the end piece. On the other side of things, you might say, let's say it's a permanent policy. You might take a lesser amount, what's called a paid up amount, and just say, look, I can't afford these payments anymore. I don't need the insurance. So I'm going to donate the reduced death benefit. That's another approach. So again, this comes down to planning. I'm not suggesting that anybody go out and get a policy for insurance purposes that they can't afford. In the example of my Canada pension plan, it's someone who didn't need the CPP. They were it was just money they're going to be taxed on. They've been, successful elsewhere. So understanding first and foremost what your cash flows are, in and out, understanding what the assets are. It's no different than a business. You got an asset, you got a balance sheet, you got an income statement, for the household, and then you got a strategic plan in place, part of which could be philanthropic. So insurance plays a part in it. You should not be buying insurance to if you can't afford it, specifically for that, and it's going to put some stress on you.
Great. Well, Ron, for all of you listening, Ron and I try to follow the sage advice of Dale Carnegie: start on time, end on time. We have 3 minutes left, and I wanted to allow a bit of time for Ron just to offer a final comment, piece of advice on, you've been able to participate with us in a 1-hour session on do well by doing good, strategic, tax-effective giving strategies. So what do you have as a parting bit of advice? And then I'll wrap up.
So first of all, thank you, because all of you have taken the first step if you're on this call in terms of being inquisitive and you're obviously philanthropically minded. So thank you for that. As I showed right in the beginning, we do, we're good. We're in the top 10 from a giving perspective. Let's see if we can collectively move that the top 5 over the next number of years. We're in a very difficult time globally and here in Canada with the difficulties many people are facing, and many of us are blessed. And so, if you think you can only give X, reach out to your advisor. If you don't have an advisor who's talking to you about this, reach out to us, and then I would encourage you to, talk to us about different ways of giving, if that's really an objective of yours.
Yeah, great. Thanks for that, Ron. And I would just add my comment that, really appreciate people who are philanthropic, generous. It makes a massive difference in our society. Nikola Wealth shares those same values, and Ron and I would look forward to meeting with anyone or chatting with anyone who has an interest in discussing this further. And at this point, I really appreciate everybody's time, and have a good rest of the day. Thanks a lot for joining us.
Thank you, everybody. Be healthy. Bye-bye.
Okay, bye.